Hi, Kelly. Can you hear me?
I can hear you. Can you hear me?
Yes.
Okay, great.
I can't tell who else is on.
I know it has a little symbol like there's 4 sets of eyes somewhere.
Hmm.
Hello, ladies. Hello, hello.
Hi, Donna.
I think Alex is having some problems getting in, like I was having. So apologize for the delay. Amy, how do you pronounce your last name? I want to hear you say it.
Caiazza.
Caiazza. Okay, perfect. All right, let me just figure out what's going on here.
Hello, everyone. I'm so sorry about that. We're having some technical difficulties. But if you are ready to start, I am. So I'm just going to jump right in. Okay, welcome to the Investor Track at LeadHERs Summit. Today's agenda will be as follows. First, we will begin with a presentation from Amy Caiazza and Kelly Chapman. Then we will go into moderated discussion led by Donna Lecky. And finally, we'll leave some time to answer questions you have for the panel. As for questions, please place any you have in the chat. I will be tracking all that are mentioned, and if they're not addressed by the panelists, I'll be sure to present them your question. Without further ado, I'd like to introduce today's panelists, Donna Lecky, Amy Caiazza, and Kelly Chapman. Donna Lecky, who you met earlier on the stage today, is a seasoned corporate executive, tax attorney and accountant, venture capitalist, and entrepreneur. In addition to co-founding HealthVenture, she leads our venture fund and investment process as managing director of HealthVenture Capital. She brings over 25 years of experience in law, finance, restructuring, and due diligence to work with founders on strategy planning, business development, and team management. Most recently, she was chief tax officer and tax counsel at Omnicare, now a CVS company. She was part of the deal team that worked on the $13 billion sale of Omnicare to CVS in 2015. Amy Caiazza is a partner at Wilson Sonsini covering securities, fintech, and blockchain. She advises clients on regulatory and transactional matters involving securities and commodities laws. Some of her clients include AngelList, NASDAQ Private Markets, Bitwise, Prime Trust, and Stockpile. She advises clients in connection with a wide range of issues, including but not limited to investment platforms, cryptocurrencies, and other crypto assets, and securities law regulatory advice. Prior to joining the firm, Amy was associate in the investment management practice at K&L Gates. Before attending law school, Amy spent 10 years developing and directing a research program on political engagement and women's political participation at a think tank. Finally, Kelly Chapman is a senior associate at Wilson Sonsini in the San Francisco office. Her practice focuses on investment fund formation, fund management, and operational matters, and related securities regulation. In addition to deep experience advising large established investment fund sponsors, Kelly has significant experience working with first-time fund sponsors and sponsors raising funds with less than $100 million. She also has a specialty in providing guidance and assistance on the important and unique business and regulatory issues that first-time fund managers face. Prior to joining the firm, Kelly was an associate at Fried, Frank, Harris, Shriver, and Jacobson, where she represented private equity and large hedge fund firms in various aspects of fund formation and management. Before we get to the panel portion of the session, please welcome Kelly and Amy to the virtual stage for an opening presentation. Afterward, Donna will join them for a moderated discussion. Thank you.
Awesome. So I guess we just get started. Thank you so much. That was an amazing introduction. We're really excited to be here. Amy, I don't know if you have any opening words before we dive in.
Yeah, thanks for everyone for attending. We're really happy to be here and excited to hopefully have a nice discussion with everybody today.
Awesome. So I will also apologize in advance. I have a puppy that likes to get involved with my video chats. So if that happens, I apologize. So I think we're starting out this session, the question is sort of, should I raise a fund? What should I be thinking about when I'm considering that question? So we're going to start out with just a few minute kind of initial presentation with some of the big picture things that we think are important when kind of thinking about that question. So I think the first question or topic that we wanted to cover was the pros and cons of managing third-party capital versus angel investing. So we don't know fully what all of your backgrounds are, but we can imagine there's kind of a diverse range of folks listening in today. And so some of you may work, currently at venture firms or other type of investment management firms. Some of you may, be more in operations at a startup, but in any event, many of you may have your own kind of angel investing portfolio or thinking about getting, involved in angel investing. And so I think, the biggest thing to think about, when you're thinking about, hey, maybe I have some friends or family that I could bring into this deal. Maybe I have enough of a track record where it makes sense to start, pulling in other people's money. One of, the biggest thing is really recognizing that you will be managing third-party capital, which puts you into a totally regulated environment. So Amy, at least on my screen, you're frozen. So I don't know if you can hear me. Oh.
Am I okay now?
On my screen, you're frozen, but maybe it's I can hear you. But
okay, well, that's good. Yes, and I'll apologize too, because for last minute technical reasons, I had to be in my teenage son's room. The twin trophies are not actually mine. So as Kelly said, one of the big considerations for any kind of, if you're going to consider managing other people's money and managing a third-party fund, is that this is a regulated area. When you manage your own money and invest, you don't have to register or make any filings really with the federal or state government. But if you start managing other people's money, you end up needing to file probably in some form, either with the state or federal government as an investment advisor. That brings a lot of responsibility with it. Some of it is just filings, but some of it is substantive regulation, like making sure that you're providing your investors with all the material information they need to make a decision. You have fiduciary duties to your clients, and if that's fund, you have a fiduciary duty to the fund. So if you decide to make that decision, you really have to think carefully about whether you're in a position where you can, in fact, comply with all the applicable regulations and make all the filings. We'll talk a little bit more about that this afternoon at our session about the details of that, but you got to go in with your eyes wide open because there's a lot of responsibility associated with managing other people's money. Kelly, do you want to talk about some of the practical considerations here?
Yes. So regardless of whether you are starting a full blind pool fund, which we can kind of talk about what that means in a minute, or just raising capital on a company by company basis through special purpose vehicles, you have to think about the fact that these are illiquid investments, typically early stage, which means it's going to be many years until there's likely going to be many years until there's a liquidity event, whether that's an IPO or some sort of acquisition transaction. So in conjunction with what Amy just said, you're not just signing up for maybe a highly regulated transaction one time, as long as you have management over whether it's, a one-time investment into a company, or a blind pool fund where you're making lots of different investments, you are going to be on the hook for regulatory, contractual, and business considerations with those investors for probably 5 to 6 years. But if you're raising, a traditional fund, 10 plus years of your life, right? So you need to think about, am I willing and ready to kind of devote myself and my life to, at least the burdens of the regulatory regime, but also, frankly, the burdens of having investors that are going to be reaching out to you with questions or issues. And it's a career, it's a long time commitment, and it's not the same thing necessarily as taking a job somewhere that you could leave necessarily in the same way. I think the second part of it is, especially if you're raising a traditional blind pool fund, what we're seeing these days, especially with emerging managers, and unfortunately, with female managers and managers of color that have different kind of roadblocks to fundraising, it can take minimum 12 months to even just hit a first closing. But right now, closer to 18, 24. Some of my fund managers have taken 3 years to even get to an initial closing, which means 1 to 3 years without drawing a salary, unless you are fortunate enough to raise, startup capital. And so, there's some folks that try to do that while maintaining their day job, but it's, fundraising is a full-time job. And so thinking about if you have the resources and ability and bandwidth to really focus on that while you're not necessarily drawing a salary, that's one of the big roadblocks, that clearly is not necessarily the case if you were just investing your own capital. All right, so on that topic, it probably makes sense for us to talk about structuring and kind of what that means. So I'm sure all of you are familiar with the traditional venture fund model, which is a limited partnership or an LLC, 10-year lockup basically for the investors. You invest in multiple investments over time, you draw down capital over time. That model works great for a lot of people, but it's not the only one. And so we're not going to go totally into depth with a lot of these, but just wanted to throw it out there that when you're thinking about this, talk to your lawyers, do your research, think about whether, evergreen funds, pledge funds, rolling funds, which is a new concept that AngelList has sort of been leaking into the market. And then, SPVs, which I mentioned earlier, single purpose vehicles that invest typically in just one company. There's a lot of different ways to structure your fund and your investment vehicle. And so we always encourage people to be thoughtful and intentional with, like, maybe the traditional venture fund model doesn't fit what you're doing right now. In particular, people have been using special purpose vehicles really opportunistically, and they're increasing in popularity right now. And one way that I see them really being leveraged is emerging managers who either, only have an angel investment track record or are coming over from an investment firm but don't necessarily have their own track record, SPVs, where you would, raise capital effectively for an investment in one company, it's a really great way to get a track record going and to show proof of concept and potentially, investment returns before you're raising a fund. I've had a lot of fund managers that are successful with that. But, Amy, can you mention some of the regulatory considerations that apply nonetheless in an SPV?
Yeah, so a lot of times the way that these SPVs work, as Kelly said, is that you can go on a platform like AngelList or Funders Club or other types of platforms, and you can kind of be the lead for that SPV, which puts you in a position where you're essentially the advisor, the manager to the SPV. So even though it's a single investment fund, the same exact considerations apply as if you were starting your own fund and we're going to be managing multiple investments in a bunch of different underlying companies. You're still an advisor. You have to, in that case, you may be supervised by the advisor that's associated with the platform, but you still have the same types of obligations to the fund, and you have an obligation to put the interests of the fund over your own. That's a big deal. Sometimes, in fact, those platforms will kind of disclaim any kind of regulatory liability to you, and so you still have responsibilities to do filings and those sorts of things. And it's a little bit case by case, but again, even if you structure so that you're relying on a platform like AngelList, you do have to, on an ongoing basis, be thinking about what the regulatory obligations are and what you need to be doing.
As a side note, Amy, is there a de minimis exemption if you only raise $50,000 or if you only raise capital from friends and family?
No, there's no de minimis exemption. In fact, one of the downsides of doing smaller fundraisings is that if you're under 20, generally actually 100 million in assets under management, you usually have to register or file in your state, and you may have to register or file in states where your investors are. If you get above that 100 million in assets under management, you can register federally with the SEC, which is far preferable because it preempts state law. And so the smaller fund ends up being it doesn't fly under the radar screen, and it ends up being a little bit more precarious from a state regulatory standpoint.
Thank you. That question comes up a lot, as you can imagine. All right, so now that we've talked about structuring, let's say you've decided you're doing you're going to start with SPVs, or you're going to start with, go out, try to raise a venture capital fund. One of the major things to think about is whether you should start out automatically with working with a law firm. I mean, I think you should always contact legal counsel in general, but in terms of the actual fund formation, should you start out by working with a law firm, or should you use one of these fundraising platforms that Amy was mentioning? There are definitely benefits to both and downsides to both. I would recommend talking to counsel, talking to the fundraising platforms to kind of see what really fits for you and your fundraising strategy and your investor base. So as you can imagine, law firms tend to be a little bit more expensive than these fundraising platforms. Firms like Wilson and other VC specific kind of focused law firms are better at coming up with kind of a startup package and keeping costs lower. But regardless, it's still going to be less expensive typically for you to raise capital on a fundraising platform. With that being said, to the extent that you are raising or you anticipate raising many SPVs or raising a larger fund, it may end up being more cost efficient to work with a law firm simply because of economies of scale. Another consideration is that these fundraising platforms, AngelList, for example, they offer a suite of services in terms of back office administration and support that you aren't going to get through a law firm, because that's just not what we do, right? So part of being a fund manager is reporting on your investments, providing tax statements on an annual basis to your investors, Keeping track of accounting, sending out capital call notices, distributions. There are fund administrators out there that you can hire to do these things. Aduro, Carta, I'm sure, you may have all heard of a large number of the kind of top 5 of these, but it's more expensive to use them, to hire them separately than if you were to use typically a fundraising platform like AngelList. On the flip side, the fundraising platforms typically use form documents that are intended to be very basic, very plain vanilla, not to be negotiated, not to be adjusted. So if there's anything about your strategy or the way that you want to operate that's maybe a little bit different and not kind of a plain vanilla approach, you're probably better working with a law firm that can help you tailor those documents. And, additionally, if you think that your investor base is going to include sophisticated investors, institutional investors that are likely to provide comments on your partnership agreement or ask for signed letters, that's typically where working with a law firm might end up making more sense for you. And I think all of those considerations apply to raising SPVs as well as traditional blind pool funds. So, you can raise a fund on AngelList. I've had some clients that have done that, for their first fund where they were really focused on kind of high net worth individuals, friends and family, and then they sort of graduate to working with a law firm. Amy, do you have anything? Sorry to catch you while you're drinking. Do you have anything to add to that?
Not really, only the general concept that, as Kelly said, working with a law firm also means that you're going to get the kind of regulatory counseling that you may need, especially if you are new to this. If it's something you've done before, that's a different set of concepts, because you may have some familiarity with what you need to do and what you can and can't do. Again, we'll discuss a lot more in the second session, but a law firm can really help you with guardrails, help you with just a basic sense of what you need to be thinking about as you're making investment decisions, what you need to tell investors, and can also just let you know the really easy ways that people often run afoul of laws because they just don't even realize a law might apply in a particular scenario. So your law firm, especially if you're working with a good, experienced fund law firm, can be a right-hand person to make sure that you stay out of trouble, basically.
That's a great point. I think if you're thinking that working with a fundraising platform is the right option for you, I would still recommend reaching out to fund or regulatory counsel to just make sure, like Amy said, that you're not running afoul of any issues that are going to set you up for heartache later on. I think one of our questions later on is kind of focused on mistakes, and that would be one of the ones that we'll probably talk about. I think that was it for our kind of initial presentation. I don't know if we can switch over to the discussion portion. There we go.
There we go. Here we are. That was phenomenal, ladies. I really appreciate your feedback and your insights. It's interesting because you see a number of people who decide that they just want to raise a fund, and they really don't understand the level of complexity as well as intricacies associated with it. You can have a really, really huge issue with the SEC, with the IRS, and other regulatory agencies, not to mention the fact getting sued for not handling your the funds appropriately by the individuals that you have funds by. So, as we're looking into the topic as to whether or not I should raise a fund, I guess one of the things that comes to mind right away is who shouldn't raise a fund?
Who should not raise a fund?
Who should not raise a fund?
Oh, that's a really great question. I think it's almost like the flip side of some of the things that we've talked about. If you don't have the time commitment or the bandwidth or the resources to take it seriously, to be able to seek out legal representation, to be able to talk to your accountants, administrators, I think that would be my number one thing, is to be honest with yourself about whether you really have what it takes, or you have a team, or you have a partner that can help you do that. Because like you said, there's a lot of people that have, they're great investors, they have great connections, but there's the whole, 75% else of what it takes to raise and operate a fund that kind of is the difference maker. Yeah, I think there's that. I think, frankly, if you're not willing to spend some money, you know, on legal fees, right? There's some folks that kind of view the lawyers as an afterthought and kind of just a necessary evil. So let's just do the bare minimum and cut corners. And this is, you know, obviously as lawyers, we wouldn't recommend you cutting corners in any fashion, but especially with this area, it's just really, it's really highly regulated. And I think understanding that and just like Amy said, kind of that next step up from, you know, startup investing. I don't know if Amy, if you have other answers to that.
Yeah, I mean, I think from a practical standpoint too, if you don't have the kinds of connections that it takes to find investors, it's probably going to take so much legwork to get started that it may not be worth it. And so, you know, someone who just doesn't have the ability to bring in investors, and especially investors at the beginning that are going to help you with your proof of concept, it's not necessarily a good idea unless you have enough time and resources to be able to spend the time doing that.
Thank you for that. You know, it's interesting, as you were both commenting, I was thinking about how involved this process really is, and looking at the level of expertise that frankly is required. And there's no real formal education that sort of takes you from soup to nuts in this area. And so optimally, when you're thinking about a fund management team, what does that look like? What are the skill sets? How many people? How should a fund management team, what should it look like, and how should they prioritize and prepare?
That's a great question. I think from my vantage point, I'll give you the ideal answer and then the practical answer. So ideally, you know, in my experience, and obviously Donna, you can speak to this too, you kind of have the you know, one or two or a handful of kind of top dogs, for lack of a better word, that are, you know, big names, big, you know, connections. Maybe they have the deal flow, maybe they have connections to investors, but they're kind of what we would call just the GPs, the day-to-day folks that are really leading the business efforts. I think, you know, connections to investors, connections to deal flow, just connections basically would be important for those folks. Then ideally someone who is either kind of general counsel, compliance, somebody who is in charge of administering and making sure that the fund and funds are operating in compliance with not just regulations, but your contracts. So your partnership agreement, your side letters, anything random that comes up like that, making sure that the accountants are on, you know, doing what they need to be doing, making sure the auditors are doing what they need to be doing. Beyond that, you know, analysts, folks that can help due diligence on investments, where that's kind of their dedicated work is diligencing, potentially sourcing and diligencing investments. You know, administration, things like, to the extent you don't use an outside administrator to do this, sending capital call notices, helping prepare and send out quarterly reporting, things like that. So that's kind of, from my vantage point, an ideal situation. But I recognize not every fund manager has the, you know, the capital, frankly, to pay a full team to do that. And so to the extent that you don't, think about, you know, having to condense all of those activities into one or two people, maybe three people. It's a lot, right? I have a lot of fund managers that they're raising 25, 30, 40 million. So they don't have the fees to pay a full team like that. So they do the best they can to outsource what they can, and then have people kind of wearing multiple hats, and they just do the best they can.
Mm-hmm.
I don't know if that helps. But...
Yeah, I mean, it hits some of the major points, and I think one of the things that's really important is that when you work with a firm such as your firm, I mean, the reality of it is that that's the reason why people have specialties, is because it's particularly in regulatory areas, regulated areas, you don't want to be sort of a jack of all trades and you know, a master of none. You want to be really expert in what it is that you're doing, because the rules and the regulations change, and you have to understand sort of the how they interact and sort of cross over, and one provision may say this, but what's the interpretation of the next provision? So to your point around having that level of expertise, it's really important, because at the end of the day you might find yourself, I think, sort of penny wise and pound foolish, where you're spending money at the end of the trying to get the transactions done, trying to set up as a fund and have all the requisite documentation in place, which can be an expensive process, but it's more expensive on the back end if it's done wrong.
Yes.
Yeah.
Yes. I was going to say, Amy has lots of examples of clients who have unfortunately.
Yeah, we way too often we have clients who come to us after they've gotten into problems, either because the documentation isn't well written and they need to kind of interpret it and extricate the meaning and negotiate with investors about it, or worse, they're in some kind of regulatory trouble, and so they're having to negotiate with the SEC or the staff of the SEC, which costs a lot more than just getting it right to begin with. So your point is exactly right.
So what are some of the key operational factors fund managers need to consider as they determine their fund size, the structure, the strategy, and what types of firms can assist in this process? You mentioned earlier about legal, of course, and accounting, but let's talk a little bit more around that, as well as how do you figure out what my fund needs to look like?
What your fund needs to
look like? How do I structure the fund? I mean, what are the things that I need to consider as I'm thinking through size and structure and strategy?
Mm-hmm. It's a great question. I think that's one area where people get a little bit, overwhelmed, right, in the beginning, because you're trying to say, well, what is my strategy? What is my fund? I think coming back to the idea of being honest with yourself and realistic, right? So some fund managers set out and just say, I just want to raise a venture fund. I don't want there to be any restrictions. I don't want to focus on a subsector, an industry, or anything like that. I don't want to worry about who my investors are. I'm just going to talk to everybody and I'm going to invest in everything. More often than not, obviously that strategy doesn't work all that well, especially if you're an emerging manager. And so I think for me, the first thing is, what is your investment strategy? What could you bring uniquely to an industry that's already oversaturated, probably, with lots of people trying to raise funds? You can tweak and hone your strategy over time. And I think that happens a lot, especially as you go out and talk to investors and kind of get a sense of what they're looking for. But I think really thinking about what sets you apart is one of the kind of primary things to think about. The second is, and it partly goes back to what Amy was saying in terms of your network and fundraising, also being realistic about how much capital you're targeting for your first fund. If you don't have the connections to raise a $100 million fund, that's fine. But it looks very different when someone sets out and says, I'm targeting 100 million, and then they only end up raising 25 million. For a lot of people, that's a huge success. 25 million, I mean, that's great. But you could end up looking like you failed if you set your bar too high.
And if I could pause you, that's a great point, because I think that's oftentimes a misperception that if I hit that a quarter of it, at least I hit a quarter of it. If I hit 50%, I hit 50%. But what does that signal to the investment community?
From my vantage point, I mean, I think, Amy, you probably have some regulatory considerations in terms of setting out to raise 100 million and only raising 25 million. But, I think it signals that you may not have known yourself well enough to set that target at an appropriate level, right? It's one thing to target 30 and only hit 25. But it also comes down to, do you have the bandwidth, the deal flow, the operations to actually run $100 million fund? You're going to obviously be making fewer investments if you raise 25 million. You're going to have lower management fees. You're not going to have as much of a budget to pay your staff, and those are things that especially some institutional larger investors really do diligence to make sure that you have the time you need, you have the support that you need. And so if you if you plan it all out as if you were raising 100 million and then you only end up raising 25, it kind of has these implications of, well, what does the team look like now? What does the deal flow look like? What, it kind of changes everything, which is fine, but it just doesn't, I think from an investor's perspective, it kind of makes you question whether that fund manager, maybe a little bit of your judgment and discretion in terms of what you set out to do.
Amy, what are your thoughts?
Well, as you referenced, and I discussed really briefly before, if you don't raise as much as you think you're going to raise, and you've kind of planned on, for example, registering with the SEC because you raise a $100 million fund, you may find yourself having to change your registration, withdraw it, and then you stay where you are because you dropped another $100 million level. And that is an issue both logistically, like you've got to pay for the other registration through the additional filings, but it's also, again, I think as Kelly is saying, the expectations of your client or of your investors may be that you're going to be an SEC advisor, and you can no longer do that. So, ultimately, you're kind of guessing at the outset where you're going to be, and if you're wrong about that, it can raise logistical issues associated with this, right?
Well, that's a great point, because it's not just optically what that looks like from a reputational and a credibility perspective. It's all, again, the additional costs associated with going in and now having to refile and update and the rest of it.
Yep.
Because you didn't get it right the first time. So
Yep.
it's really a function of really understanding who you're targeting, what that target list looks like, and almost really coming up with a percentage of achievability with those targets, right? To determine what that number looks like. And that's a model for, establishing metrics and reporting that's really important, because a lot of that has to also do with the fact that once you've communicated with those investors and you've not hit the mark, now the question has to tie into sort of the capital calls and if I'm sitting in as an investor, I'm saying, well, you were supposed to raise 100, but you only raised 25. I'm in, and now I'm committed to be in because I've signed the paperwork. But what does that do to the viability of this investment now?
Yeah.
So it's a lot of considerations of not just how that impacts your firm if you're raising the fund, but also all of these other tentacles that are impacted, right?
Yep.
So why do funds fail? I mean, I know we've talked about some of the reasons just by organization and team and not really thinking through maybe necessarily methodically about whether or not this is something I should really be doing, as well as how to really do it and making sure I have the right team. But do you have a sense for how quickly funds fail and or maybe a percentage of failure, which if there's a failure rate, so to say, and what would you say would be the top 2-3 reasons why funds fail? And then I'm going to ask you the other side of that is, if you fail as a fund and then you want to come back into the fundraising community, how is that perceived?
Those are great questions. Okay, I'm going to try to start with some of them, but please remind me if I go.
I have to remind myself, Kelly.
So the failure rate, it's a great question. I actually don't know for sure. In part, I think, because they're long funds, right? So often you will not know whether you're going to fail, assuming you get past fundraising, right? So you may not know if you're going to fail until you're into year 5, 6, 7, assuming something awful regulatory wise hasn't happened that just shuts you down. And it's kind of interesting. So if you have decent deal flow and decent valuations, a lot of funds, as long as you raised fund 1, you can kind of raise fund 2 without having proof that fund 1 really performed how you were expecting. So I think in some ways you maybe have more flexibility if you can have that momentum from a fund 1 fundraise. But putting that aside, my guess would be the failure rate is probably close to what the startup failure rate is. I mean, I don't know, Donna, if you have in your experience, like smaller fund managers in particular that don't maybe have the sophisticated networks or capital, frankly, operating capital beyond management fees to keep them going. Maybe, and this is me saying or thinking of a failure as failing to raise another fund, basically, because the fund itself didn't perform well. I think from my vantage point, reasons for failure, they range. One would be, not being able to raise the amount that you intended to, whether that's just you missed the mark with your expectations, or sometimes there's regulatory things that come up, like CFIUS, the Committee for Foreign Investment in the United States. There were massive changes to that a couple of years ago that really it impacted a lot of our fund managers that were looking to raise capital from Asia, for example. And so we saw a lot of funds that just didn't raise what they were expecting to, and they're unlikely to raise a fund to. I think people that get overwhelmed with the operational stuff and they just don't keep up in a way that their investors are happy with, and so they don't sign on for another fund. What else were we thinking about on that one?
I can jump in. I think two that I see. One is you make things more complex than they need to be. Sometimes dealing with these questions like structure and how fees are paid and how returns are paid and those types of things. There are easy, relatively well-trodden ways that you can address those questions. But sometimes I see fund managers that want to do something that's so innovative and amazing, but it's expensive to set it up. It's complicated to administer. It's complicated to explain, and it kind of, dies under the weight of its own complexity. And then the other, which is on the regulatory person here, we see funds fail because they get in regulatory trouble. They don't do the right thing. Pay attention to what's going on. Investors get upset. Enforcers come in, and it's a very expensive very quickly once you bring a lawyer in. And that could be crushing from an economics point of view.
Okay, Amy, you're going a little bit in and out. I'm not sure if there's a good connection, but I want to switch gears a little bit to the actual structure of a fund, and in particular as it relates to introducing a general partner or a new general partner, or even the departure of one. How does that impact the structure and the economics of the fund?
So I'll start with the departure question first. So from a practical perspective, there's operations, right? What we were just talking about. Are you now missing a key part of your team that was helping you administer your fund or fundraise, all of that. Number two is contractually, was this person who's departing a key person, which is from an investor standpoint, kind of, we invest in the firm because we believe in this 1, 2, 3, these people. And if they leave, most often that's called a key person event, and the fund itself needs to stop investing new money. So questions of whether, are there implications in your partnership agreement, your side letters that require LP relations or potentially even shutting down your investment period. The third is just thinking about, well, contractually, what is this person entitled to? Did we set up an employment agreement that gave them equity in the GP? Have they vested, or, where are they at in terms of vesting? Usually departures, especially of higher level people that have equity, there's usually a I guess it depends on the amount of leverage they have, but a fairly extensive separation process in terms of, can they use the track record? If so, what can they use? What titles can they use? Are there any type of non-compete or non-solicit restrictions? So there can be a fairly extensive legal negotiation process depending on how senior and kind of important the person is that's leaving. And then I guess on the flip side, if you're bringing somebody in, maybe it's to replace someone, or because you're raising your next fund and you have some capital to bring on someone, it's kind of the flip side of considerations, thinking about how much equity compensation should they be entitled to, what should their vesting schedule be, what should their base salary be, with your limited resources. You know, what management rights should they have, if any? And those are, as you can imagine, highly negotiated things as well. I don't know, what else am I missing? If you have other... Oh, you're on mute.
Amy?
You're muted, Amy.
Sorry, hopefully you can hear me now. If one of the people who controls the management of the fund leaves, it could become what's called a change in control event because of the Advisors Act provisions. And under the Advisors Act, if there's a change of control, all of your investors have the right to consent or have to consent to that change, and they would have the right to rescind the investment, which would obviously be a pretty big deal. And so that's definitely something to be thinking about as you're going into if you're going to be in partnership with somebody else making decisions. What happens if they leave? So, you know, like any other kind of business relationship and partnership, you want to be really clear about what the consequences are when someone leaves and how you're going to handle that. And the more you can bake that stuff, the operating agreements and the contracts around the fund, better, because that's protective of everybody.
You know, that's an interesting point. I mean, we all are come from the law schools and have had you know, experience with partnership law as an example. And I would think that if you've got a general partner and there's one other partner in the partnership, just by definition, I mean, if you have a departure of one, you would have basically the potentiality of a winding down of the partnership in and of itself, right? Yep. And that could be, quite frankly, disastrous, because it's not just the impact that it has on the investment community, but the question is what type of impact it has on the fund itself, as well as whether or not a partnership truly exists. So that's another point. And I think that, Amy, I couldn't echo more. It's really, really important to understand who you are getting into business with.
Yep.
And it's not just vetting the person, but you know, understanding the experiences, understanding the trust factor, looking at, you know, bonding, you know, I mean, there's just a lot that goes along with it, because you are investing other people's money into investments. And so it's really, really, really critical that you're clear about who it is that you're in this business with, as a general partner, and also as you bring on limited partners. So, you know, many assume that I've got a $50 million fund, that means that 50 million is available in the bank account immediately. Can you educate our audience a little bit more about what that 50 million really, really means, and the a little bit more on sort of the capital call process?
Sure. So I think there's two pieces to this. One is, what does that 50 million mean in terms of investable capital, right? So typically you're charging a management fee that's between 2 and 2.5% annually. So fund life of 10 plus years, that can significantly eat into the capital that you're going to invest with. You've got your fund expenses that come out of that. So legal startup costs, accounting costs, tax accounting, you know, miscellaneous legal and regulatory expenses, diligence costs to a certain extent, that also comes out of that 50 million. So, you know, thinking about your investment program, really budgeting it out and thinking about, all right, what portion of this money am I realistically going to be able to invest? What portion do I want to reserve for follow-on investments, because that can be critical? And then how much do I just want to reserve just in case? So that, 50 million can very quickly be whittled down in terms of what's actually investable. And then the second part of it is, when does that money come in? What's the cadence? Typically, for very, very small funds and for special purpose vehicles that their only purpose is to make one investment in one company, you often do see capital fall down all at once. Often because just administratively it's easier. Well, I guess putting aside the SPV, but for any fund that's typical line pool investment fund where you're making multiple investments, you're calling that capital down over time, often on at least a quarterly basis to pay your management fees to yourself, but also on an as needed basis as investments come up. So very rarely are you just handed all of the capital up front for it to sit in the bank account. There's a number of reasons for that we can talk about if you think they're interesting, but more often than not, it's really, all right, quarterly calls for management fees and fund expenses and as needed for investments as they arise.
Any thoughts, Amy?
Yeah, I mean, just to state the obvious, from a practical standpoint, what that means is that if you want to invest $50 million, you probably have to raise 55 or 60, whatever bank account that is. And so I have seen fund managers new fund managers not realize that and even commit to investments that are beyond what they really can invest. And then they have to go back and renegotiate with the underlying company, the investment, and that gets really difficult because the money doesn't go overseas.
That's a great point. I mean, both of you guys have just really elucidated the key concerns, and from to your point, and from a very practical perspective, 50 million isn't 50 million. 50 million is 55, 57 plus to manage that entire process. Mm-hmm. So as we're thinking about sort of the limited partner agreements, what would be, from your perspective, maybe the top 2 or 3 set of terms, key terms that need to be in the agreements?
That need to be included for...
Yes.
Ooh, that's a tough one. As you know, the partnership agreements are often 50 to 80 plus pages, depending on which law firm you're working with and what your fund strategy is. So there is a lot. I'm trying to think of basic.
Well, definitely the distributions have to be up there, right?
Mm-hmm.
Yeah.
The distribution provision. And maybe subsumed in that, something we haven't talked about yet, which is tax. Taxes,
tax, yeah.
One of the things you want to do is make sure that your partnership is taxed as a partnership, and that all of your calculations of distributions and allocations are done correctly, so that you continue to qualify for that status. You can mess it up, that you don't. And I guess I'm assuming everyone basically knows this, but the advantage of a partnership is that there is no taxation of the profits within the partnership. The taxation occurs based on the partner status. But if a partnership is taxed as a corporation, there's double taxation, right? Both on what the partnership generates and on the partner. And you can lose that if you don't really deal with tax with respect to distribution.
Yeah, I would say there's, kind of the basic framework of capital call mechanics, allocation distributions, what happens at the end of the fund's life, whether there's a clause that allows the investors to vote to remove the general partner with or without clause. But specific things that I think are really, just off the top of my head, important to think about would be, number one, making sure you have the ability to reserve capital that comes in through a distribution. Whether that's for future expenses or future investments, but that's one way that people, and whether it's, reinvesting it or if it's literally just using it for expenses, that's one way that you can get the most bang out of your buck for your fund, is to be able to do that. But as I've seen some institutional investors push back a lot because they just don't want the manager to have that type of discretion. They want their money and they want it to get distributed fast. And so I'd say making sure you have flexibility in your reserves. Number two is outlining, and I think this is overlooked a lot, fund expenses. Amy can talk about this. The SEC cares a lot about the allocation of fund expenses and disclosure of those items. And so thinking about, here's the basic list of things that are chargeable to a fund, but for you in particular, are there other things that you want to be able to reasonably charge to the fund that aren't included in there? So for example, I work with a lot of accelerator related funds, and there may be a bucket of either a set dollar amount or a percentage that goes to helping with the administration of the accelerator, or things like that, to make sure that you're basically getting the fund to cover as much as you can within reason and within market and within the law. So you're not paying for out of your management fees. Amy, do you want to talk about anything on that?
No, I think just to reiterate how much care you need to put into your documentation. And moving from the partnership agreement, you also have to be really clear with investors what the terms are here, because as Kelly said, these partnership agreements are often 50 to 60 pages. They're very legalistic, and they're not necessarily something that just a regular non-lawyer is going to make heads or tails of.
Very true.
But
even a lawyer.
Yes,
even
very good.
In that field, right?
Yeah.
It's a very specialized practice, and so you have to be able to explain it in simple terms and understandable terms to your investors. Otherwise, you end up with problems on the back end when people think it's not working the way that it's going to work, or they didn't understand the risk, whatever it might be.
So, in your experience, and legally speaking, do limited partners have any wiggle room regarding the capital call? Have you seen? Are they contractually liable, and what recourse does a fund manager have if they try to wiggle out of a capital call?
That's a great question. So typically in these documents, you might have half a page, 2 pages of various default remedies that a general partner can use in the event that there is a default by an investor. So theoretically, and they're extensive. There are multitude of different approaches. And they're pretty draconian. For example, even if you miss, let's say, a one-time management fee capital call, theoretically you could have half or more of your entire capital account drained because of that. Practically speaking, though, in my experience, defaults don't happen often, and when they do, there's something going on that is usually kind of understandable. And so my fund managers, more often than not, give flexibility, kind of give whether it's working with the investor to kind of say, all right now you're having some liquidity issues. When do you think you can get us the money by? Can you get us part of it? Coming up with a plan, because in my experience, more often than not, it's a temporary thing. It's not something that's permanent. In the event that it is a permanent issue, whether it's somebody acting in bad faith, that they just decide they don't want to do it anymore, which does happen often with some smaller individuals that frankly didn't know what they were signing up for, or it's something else where there's a financial crisis or something specific to that investor that just makes it impossible to keep going. In my experience, the fund managers are typically find it to their benefit to be flexible and understanding, and to not necessarily employ the super draconian measures. I don't know if you guys have seen folks actually kind of litigate and go after defaulting investors, but I think in practice, it often just is kind of like, that's too bad, but not gonna go sue somebody to pay us. We're just going to take over the rest of their capital account or something like that.
My experience has been, especially with the emerging fund managers, they frankly just don't have the resources or the ability to go after a partner, right?
Yeah.
Because of the costs associated with that. And I'm sorry, go ahead.
No, sorry. And there's a reputational thing there too. You don't want to be known as the person who litigates against their limited partners.
And that was one of the things that you must have read my mind, because I was going to ask, when you look at that, like because of this business is so relationship driven, right? That what is the perception of that? I mean, because the fund could be spot on and well within, their rights to go after that limited partner, but the results can be costly from a number of different aspects, no?
Yep, absolutely.
Completely agree.
And so before we go to the chat, and I know we're running a little behind, but we started a little late. I wanted to talk about the global nature. I mean, today, limited partners are sourced from not only the U.S., of course, but different parts of the world. And so when you're dealing with limited partnership agreements, and you're dealing with the nuances associated with those agreements and fund managers, can you talk to us about some of the things that a fund manager, emerging fund manager, needs to consider by way of not only provisions, but just some of the things that come to mind for me, for example, would be whether or not there are regulatory issues that don't cross-translate between, say, the U.S. and the UK, or even agreements that I've been involved with where the terminology of what in the language and the provisions are understood to be different things versus in one country versus another, like the bad lover, good lover, as an example. So can you talk a little bit about sort of the things that if you are a fund manager and you are looking to limited partners and investment partners globally, what are some of the key things you ought to be thinking about?
Amy, do you want to start out with talking about the regular, sort of securities offering considerations?
Yeah, this is actually one of the really interesting areas in which we see pitfalls, and that's partially because I've had clients who said, you know what, U.S. securities laws are too difficult. I'm going to really focus on non-U.S. because then I don't have to deal with all these regulatory things. Well, certainly all the other countries in the world have laws, not just us. And so if you're going to be reaching out to non-U.S. investors, you have to not only, potentially comply with U.S. law, but you have to consider what's going on in non-U.S. law. It is generally true that the U.S. is among the more strict of the regulatory, but that's not universally true, and it's also very true that other countries may regulate in surprisingly different areas, and that may kind of throw off how you do your offering. What that often means is that it does increase your legal costs quite a bit, because if you're going to go to the UK, for example, you've got to hire a UK counsel in order to understand what you can do there. Same with the European Union, China, Korea, other areas where we see a lot of investment activity. And so it can complicate things. The other piece of it is structurally, and Kelly can talk about this in more depth than I can, but structurally the tax considerations change quite a bit. You've got foreign investors, and so you may have to have two funds that are identical to each other, one for U.S. investors and one for foreign investors. You may even need a third if you've got tax exempt investors in the U.S. And so it does end up complicating some of the structural issues as well. Since Kelly's on the ground with the structural issues, she probably has more to say about that, but it's an important consideration.
Yeah, that's where I was going to go.
Right.
I think for larger, and when I say larger, I mean like hundreds of millions of dollars and billion-dollar fund managers. Not only are they, very good about hiring counsel, local counsel, and all the jurisdictions that they're offering in, but they also have perhaps more flexibility to set up parallel funds, feeder funds, master feeder structures to help accommodate both the U.S. and non-U.S. investors and their unique tax considerations. For smaller funds though, sub 100 million, but I mean, frankly, even sub 250, we try to avoid as much of that complexity as possible. And so that's where conversations with your tax counsel and investors, non-US investors tax counsel, can be really helpful. And obviously, Donna, you can speak to this way better than we can, but I in my experience, a lot of non-US investors, their knee-jerk reaction is, I don't want to invest in a Delaware fund, do it offshore. And that used to be easier because the Cayman Islands were kind of the go-to place to set up limited partnerships. It was quick and relatively quick, relatively easy. But over the last 2-3 years, they have implemented some very significant, burdensome requirements in terms of anti-money laundering, in terms of economic substance. So more or less other countries got frustrated that the Cayman Islands were becoming, viewed as a tax shelter and kind of this place where people could go raise money and not have the burdens of raising it elsewhere. And so in this current moment in time, and I would be interested, Donna, if you have thoughts on this, we are trying as hard as we can to really work with non-US investors to say, do you really need to go to Cayman? Do you really need a non-US? Because right now Delaware is kind of the easiest place, startup cost and administratively to get a fund running. And so what types of covenants can we give you instead? Can we give you covenants to avoid the types of income that you're sensitive to? And is that enough for you, or do you really need a non-US entity?
Yeah, I think that as I've advised some of my my Yale classmates who were looking at the Cayman versus the U.S. and the Delaware entity, my advice is exactly what you just said. It's because one of the issues that you can have with respect to an offshore is that they can change the provisions at any point in time. They may or may not be retroactive. So that's the first thing. The second thing is, by the time you think about the cost of unraveling, and then and the potentiality of repatriation, right? You still have that issue because you're going to get taxed on the backside of the transaction. So the structure has to be really put in place. I love the idea of sort of the covenant play and really making sure that, what really is the issue here is what you're asking. What are you trying to avoid, and what are you trying to accomplish by way of the provision? And let's see if we can work within the frame of the U.S. tax code. So I think that one, again, is as a person who is looked at and structured a number of legal entities and looked at the boxes and figured out where the best box or triangle or sort of box triangle fits.
Yep.
The reality of it is that it's really having an understanding. And unfortunately, a lot of business owners, they have vision, but they really can't articulate what it is that they know what they want to avoid, but they can't articulate how to do it operationally or how to do it structurally. And I guess that's maybe where we come in. But if they can't articulate it, then it's really difficult for people like us to try to really figure out what the covenants ought to look like. So I think there's a lot of time that needs to be spent in really getting beneath the surface and looking at an in-depth view of that. I got to get to, we're really up against time because we're pushing into the next segment, but I really have to go to a question that was asked, and it's sort of on the theme of the international from the chat room, and that is, do you have additional funds developed to target projects for developing countries, and where can one get additional information and support regarding funds such as this? Any thoughts there?
I'm not sure if this is what the intention is, but there are infrastructure-based funds, right, that they don't invest per se in companies, but they invest in projects in developing countries that are intended to, for example, build bridges or clean tech, solar farms, things like that. I think my number one thing would be, those are different, unique type of subset of funds, and that I would highly encourage you to work with a law firm that focuses on those types of funds, because there are unique regulatory, tax, and just structuring considerations, 40 Act, Investment Company Act considerations for those types of funds. In my experience, it's also a much narrower investor base that's willing and looking to invest in those types of funds. It's, you know, it's not, you're more likely than not going to be super successful networking at, you know, in downtown San Francisco with a bunch of tech folks that, you know, are perhaps more likely to invest in a traditional VC fund that's just investing in, you know, some subsector of tech. And then I think all of the considerations that we just mentioned in terms of tax considerations and anything outside of the U.S. for investors, but also the investments themselves, would be really important to look into. I think risk factors come to mind. I don't know if Amy, if you want to talk about that, but in terms of, you know, disclosure, I think.
Right. There's going to be a different potential set of risks that people need to think about, which is that if you've got a developing country, ostensibly economic conditions can change perhaps even more quickly than they would as. You know, depending on the context, the country itself and the project itself could be really dependent on things like export and import that may or may not be reliable depending on the place. It really, obviously, there's a huge variance here in terms of what the but when we talk about making sure your investors understand what you're getting into, you got to think really hard about those types of issues. Where I've seen, I don't know if it's an upside or a downside, but where I've seen these types of funds, often limited partners are kind of interested in being more involved in certain ways. And so going back to some of the first things that we talked about, you also want to think about who are the people that you're getting into this with, and are they people I really want to post with? Are they people that are going to have a kind of shared vision, and what happens if things go wrong? I think that's just kind of reiterating what we've already said, but you know, whenever you deal with a more specialized content, you end up often with a little bit more investment. I mean, logically, the people who are, which is great, except for that sometimes too many cooks in the kitchen are not a good thing.
That's I find that never to be a good thing. So Amy and Kelly, thank you so much for part one of the fundamentals of fund formation. And we were supposed to, believe, get started, Alex, at 3 for part two.
Yeah, so we ran a little bit over. So instead of doing our 15-minute break, which was originally scheduled, I think we're actually just going to take 5 minutes for everyone to get water, stretch their legs, things like that. So plan to be back here at 3:07 if possible.
Okay.
And thank you both so much for speaking with us.
Thank you. This was great.
See
Awesome.
you
Thank you.
Bye.